Thank you for the reminder. Okay, so with that in mind, obviously this is somewhat timely as it is tax season, and I would imagine most, if not all of you on this call are self-employed. So whether this is for you yourself and your family, or for self-employed business owners that you might be working with as clients or investors, I wanted to give you some good creative solutions that give you a feel for how mortgage lenders are going to analyze income. So let's get going here. As always on these Wednesday calls, feel free to jump in the chat, interrupt me. There's no such thing as a dumb question when it comes to this sort of stuff. Mortgages are complex, and I want you to walk away saying, okay, now I feel like I have a better understanding of that, no matter how many questions it might take. So let's talk about traditional financing for self-employed borrowers who are sole proprietors. This encompasses a lot of agents. It encompasses especially a lot of newer agents where they're a sole proprietor. They own an unincorporated business by himself or herself. And typically when you have a sole proprietor, it's a pretty easy mortgage lending calculation. A lender is going to look at the last 2 years of your Schedule C, Charlie, and then average them up. It really is that simple. They're going to add up year one, they're going to add up year two, and hopefully that number is increasing year over year. And then they're going to divide by 2, and that's going to be your average income. If you look at how this actually works, I have a handy link here that is going to be simple. The coolest thing about this, in my opinion, and I'm going to get you guys links on this, is that they're giving you the test answers right away. So this is not something that's some secret mortgage calculation where they're going to do it this way and then another lender is going to do it another way. If you're talking about traditional financing for FHA, VA, USDA, Fannie Mae, Freddie Mac, the answers to the test are all out there. So this is a Schedule C, Charlie, that you may or may not be familiar with for a P&L from the business for a sole proprietorship, right? You put your name in here, right? And your social, what your occupation is, what the business name is. If there is no DBA or separate business, you're going to leave that blank. Typically, you're going to have a cash accounting method, et cetera, et cetera. And then you're going to have a number in here that is your gross receipts from sales, right? Now, the fatal mistake that a lot of business owners, whether they be realtors or whatever, will make is that this is the number that they assume a mortgage lender is going to go off of for qualifying. Hey, you know, I did $125,000 in GCI last year, right? And that's going to be the number that the lender is going to use for calculating my mortgage. Not true. What a lender is always going to work from and then backward from is this line 31, this net profit or loss in box 31, which, of course, will factor in all of the tax write-offs that we see, right? Advertising, car and truck expenses, contract labor, employee benefits, insurance, interest, mortgage and other, right? Office expense, rent or lease, repairs and maintenance, supplies, travel and meals, taxes and licenses, utilities, wages, business use of home, right? You could tell you've got a significant amount in this part 2 section of the sole proprietor worksheet that is used for tax write-offs. So ultimately, once you factor all these in, your 125, depending on how many write-offs you have, might be closer to $48,000, right? The lender is then going to work backward from line 31, and they are going to add back the stuff that is highlighted in yellow for you here. So if you have depreciation of $5,000 and depletion of another $5,000 and business use of home for another $5,000, right? That's $15,000 that's going to be added to your line 31, right? 48,000 plus 15,000, you're going to get $63,000, right? Travel is not included, but deductible meals is. And so if you dined out a lot in the name of selling clients and it's $2,500, that's going to be subtracted. But these are the key pillars that are used for a lender calculating what they add back for write-offs. They start from line 31. I'm going to go back to my slide here in a moment. They're going to add back depletion and depreciation, and then they're going to subtract deductible meals, and that's going to allow you to arrive at a number. You'll see it right here. This is a really simplified way of looking at it, where they're going to start from the net profit or loss, depletion, depreciation, travel and meals, business use of home, and that's what they're going to use, right? So they would look at 2 years of this P&L from the business, the Schedule C Charlie form, and that's how they're going to calculate self-employed income for a sole proprietor. Does that make sense to everybody? Any questions on that calculation in this tax worksheet?
I guess I had a quick question. When you went back to the previous slide, it said travel and meals were minus, but you just have meals right here on B. So is it just meals then?
Nope, you are correct. Good eye. It is travel, and that one just did not get highlighted in my handy dandy form here. But
No worries,
Jocelyn, yeah, good point. Good point. It is travel and meals, and I apologize for that. So yes, travel and meals is included in that minus section of the sole proprietor form. Any other questions on the Schedule C? It's pretty easy. Okay, awesome. Let's move on. Yeah. I'll save that for a moment. I figured out how to link a document to this PowerPoint, so I'm like super proud of myself. And then when I try and highlight that, Jocelyn, I can't save it. So it's amazing how computers will just take your pride away that way. Let's talk about traditional financing for self-employed borrowers that have an S corporation, right? The rule of thumb is, and this applies more to multiple business owners, but if you own more than 25% of the business, mortgage lenders are going to consider you self-employed. And similarly, lenders are going to look at the last 2 tax returns and add in W-2 wages if applicable, right? One of the benefits of the S corporation is that the corporation can pay your FICA taxes if you pay yourself a reasonable salary. So the example that I have here is, let's say that you're a real estate agent, Jackson's Homes. Jackson, I want to see that logo, by the way. So I'm gonna use you as an example, right? So Jackson JD Homes is the S corporation, right? And JD Homes will pay Jackson a reasonable salary of $4,000 a month or $48,000 a year, right? But while that comes off the top, there's also money to be left over that is distributed, whether it's paid out or not, as part of the S corporation agreement to the partners that are involved in the S corp, right? So if you have $48,000 that you're paying yourself as a W-2 reasonable salary, and you also have distributions of another $48,000, right? And that is a pretty consistent number over 2 years. You would add that W-2 reasonable salary to the distributions and make $8,000 a month for qualifying income. Now, the S corporation income calc is a little bit murkier. Why did I just duplicate this slide? So we have this example here, but similarly, they will give you the answers to the test. So if you're working with your accountant or you're working with Chrissy Horst or whoever it might be, this is a handy dandy calculator that you can reference, and certainly myself or Matt or anybody on the mortgage team can help you with this, where this is a self-employed income calculator that any lender is going to use. that you could simply give the lender your tax returns and this document and say, here you go. This is what I calculated my self-employment income as. What do you think? You will see this is where you have the W-2 income from self-employment. And so you've got $48,000 here and another $48,000 here. Oops, that's Johnny Rose. $48,000 here. And then you would also go down to the actual partnership income, where it will give you all of the analysis that is used, where this is the ordinary income and loss that would be on the 1120S, net rental real estate guaranteed payments to partner, and then the total K1 distribution here. So if you plugged in the other $48,000 that is representative over the last 2 years, then you will get a calculation that represents that $8,000 a month. Now, similarly, you're going to have other add backs like depreciation, similar to a Schedule C. Depreciation, depletion, amortization, casualty loss, mortgages are notes payable in less than 1 year. Travel and entertainment is also subtracted. And then it's going to multiply by your percentage of ownership, right? So if you're only a 50% ownership in the business, it's obviously going to cut your number in half, if you follow me there. But from an S Corp perspective, that is the most basic kind of analysis of what that looks like. A lot of people say, hey, I'm getting a W-2 now, right? I just formed my S Corp, and last year I paid myself $48,000 in wages. The key is that that still needs to show continuance over a 2-year period for self-employed borrowers. So just because you're getting a wage now that's paid by the self-employment institution or entity, it does not mean you can just immediately use a W-2 wage for mortgage qualifying if you have ownership in the business. Okay. Now, a lot of people come to me and say, what about 1 year? Can I use 1 year of a tax return because I just started and I made a bunch of money last year and I'm showing a lot of money on paper, but every lender is telling me that I need 2 tax return years to qualify. And the reality is that lenders will take the most recent tax return year if the business has been established for 5 years. So Matt Lundeen from our mortgage team is on this call. A lot of you know Matt. Matt was recently working with a borrower that just bought in or was made partner in a business and owned more than 25% of the business. And he had been turned down some other places for a mortgage because they said, you don't have 2 years of self-employment. And we started analyzing it and realized that the business had been around for 15 years. So once you looked at the business and the personal tax returns, the business's continuity and the fact that it had been around for a long time will allow you to use just 1 year tax return. But where this gets tricky is that if you just created an S Corp for yourself and you're a real estate agent, right? The most recent tax return will only be allowed if the business has been in effect for 5 years or more. Does that make sense? Any questions on S Corp income calc? And again, you guys, if you want to look at, okay, this was my GCI, I'm wondering how much income I should show. That's an exercise I've done many, many times with real estate agents. We want to kind of develop this a little bit more. I think it'd be awesome to have some developed webinars. Maybe we'll pull Chrissy in and, talk about, okay, how do I get approved for a mortgage as an established real estate agent? So there are, especially in the broker channel where we can go find different products and we're a lot more diversified than a retail lender or a bank, there are non-qualified mortgages that are out there that don't necessarily meet the standard of your standard Fannie Mae, Freddie Mac, FHA, VA loan. And these types of loans have really emerged over the past 24 to 36 months as good options for borrowers, real estate agents, and others that have unique income qualifying circumstances. So let's talk about this a little bit. This will most often best serve a self-employed borrower, a real estate investor, foreign nationals has been a big one, a prime or a non-prime borrower when it comes to credit score, borrowers with significant assets, and this can also be used for a variety of loan purposes, right? This can be used for purchase, refinance, cash out refi, primary residences, investment properties, or second homes. So let's talk about standard A-paper borrowers, but there are also bank statement loans, 1099 only products, asset depletion, I-10 loans for foreign nationals and individuals that may not have U.S. credit or a social. Debt service coverage ratio loans is a big one. And then also jumbo products for those loans that are above the conforming loan limit, which is for $726,200. I've got it up on my whiteboard here. I got to remember that figure. Bank statement loans are maybe the most popular of the non-QM products. They're really good for self-employed or business owners that take a lot of tax write-offs, right? So we understand that you gross a lot of income, but on paper, you don't show a lot of it, right? That's pretty much a lot of business owners in America. So that's why these products have emerged in popularity. This is a product where tax returns are not required, pay stubs are not required, 1099s are not required, K1s are not required. The only thing that's required for qualifying are bank statements, whether it be 12 months or 24 months. They can be personal bank statements, they can be business bank statements, okay? What's the catch? Typically, you're going to have a higher down payment requirement. So a bank statement loan with 3% or 5% down conventional is not going to fly. You're going to need a little bit more skin in the game. 10 to 15% down is typically that good threshold. And then there's going to be a higher rate, right? The cool thing about these non-QM products is that in the state of Minnesota, there's no prepayment penalty. So these loans can essentially serve as a bridge from now until when you want to refinance into a traditionally qualified Fannie Mae Freddie Mac product. What's an example of that? Hey, I made a bunch of money on paper and I want to buy this primary residence and I have money. I have 20% down. But, you know, I don't qualify because I just started this business a year ago. Or maybe I took a bunch of tax write-offs on my most recent tax return for 2022. All right, well, you could do a non-QM loan and put 15% down, and you're going to have a rate that might be, you know, a point and a half higher than what you're going to see out there on the market. It might be 8%, it might be 8.5%, it might be 9%. But the thought is that, you know, once you file your new tax return in 2024 for 2023, then you can refinance and there's no prepayment penalty. So essentially, it's a bridge from point A to point B. In the spirit of full transparency, I've had a hard time getting my mind around these types of loans because they are a higher interest product. And we're always in the business of trying to do what's best for the consumer and the lowest possible payment and best structure for their financial situation. The thing is, for some people, a yes is the best answer, right? So when they've been denied a loan many different places because of their business structure or tax return structure, you're telling somebody, hey, you actually do qualify for a mortgage. Here's how it's going to work. That's all they really want to hear. It's not necessarily what the rate is. Bank statement loans are really simple. All you're going to do is look at what the balance has been month over month for 12 or 24 months, and that's how the average is calculated. So if you've got a business bank account that is showing, you know, 10, 12, 25 grand going in every month, that's how a lender that does bank statement loans is going to calculate your income. It does not go through that sole proprietor or S Corp calculation that you see with Fannie Mae, Freddie Mac. Questions on bank statement loans? Cool. asset depletion and dissipation. I'm answering your call in the middle of my Wednesday training. Why aren't you on it? Can I call you back? Love it. I'll call you right back, okay? That was Josh Anschutz, in case anyone was asking. Asset depletion. I remember several years ago, one of the worst things that I had to go through was borrowers that had a ton of money and could buy a property 5 or 6 times over in cash. But I'm sorry, Mrs. Smith, you don't qualify because you only make Social Security and pension, right? And they would get very frustrated because they're saying, I have done really well in life. I'm a well-heeled borrower. I have an 800 credit score. How are you telling me with 20% down that I can't get a loan, right? The guidelines have changed for this, and this is largely through Fannie Mae and Freddie Mac. But if you have a borrower that has a bunch of assets and limited income, you can actually do a calculation where you will manufacture income for them based on the assets they have, right? The example here is a 49-year-old borrower with $2 million in liquid assets, another 500,000 in retirement or investment accounts, right? You cut down the retirement to 70%, and that gives them about $2.3 million worth of assets. You can divide that, and there are various calculations out there, you guys, but you can actually divide that liquidity by the number of months in a mortgage and come up with a figure that will support debt to income. For example, $2.35 million divided by 360 is going to give you $6,500 in income. That's just common sense. I mean, you have a hard time believing that a borrower that has 7 figures put away is going to default on a mortgage. And so this is a more common sense way of creating income when you have a borrower who is well-heeled. Does this make sense? Any questions or anybody run into this? I don't think Hannah's on this call, but Hannah and I did this in October of 2021. And it worked quite well. I've done this several times since Fannie Mae and Freddie Mac revised their guideline. The reality is I don't think a lot of LOs know about asset depletion. You can also blend this. So you can use this in connection with their Social Security or pension or even W-2 wage. So it's a great way to get a borrower over the top if they're tight on debt to income.
I actually helped a client who had a lot of assets, but he was delivering pizza at Devani's. I helped him buy like a $900,000 house with this type of loan.
I love that. I love that. Because in reality, you know, even Devani's is never going to decrease in popularity, right? But
absolutely not.
but regardless of, you know, the number of Italian subs that he may or may not deliver, he's probably not going to allow a loan that he has 20 or 30% down payment into, you know, go into default.
Yeah, he actually sold his other house and he owns it free and clear now. So
that's awesome.
Yeah.
Very cool. Yeah. Good example, Rachel. That's a great point. All right, let's talk about DSCR. This is a popular product, especially amongst mortgage brokers, for investors. You talk about, I want to buy an investment property and I don't want to go through this headache because maybe I don't qualify, or maybe I just want to buy this property. I've got the down payment, I've got good credit, and I want to add to my rental portfolio. Or I talked with somebody last weekend where they're like, I've got 10 mortgages. So Fannie Mae, Freddie Mac won't give me another mortgage. And then I got to restructure everything into a commercial loan, or I got to start doing commercial loans on residential properties. DSCR is an adequate product for that. And it stands for debt service coverage ratio, which means that a lender is simply using cash flow for qualifying. Let's use an example of this, okay? You buy a property that rents for $3,000 a month, and the monthly mortgage payment, including taxes and insurance and HOA dues, if applicable, is $2,700. The DSCR ratio, which is rent divided by mortgage payment, is 1.1111%, right? This is simply a commercial loan that is wrapped in residential loans clothing, right? Where all they're doing is this ratio, credit score, verification of down payment. That's it. There are no tax returns, there are no W-2s, there's nothing, right? And I think about Grant Cardone whenever I present this option, because, you know, he has the example of Bank of America will not lend me money to buy their stock, but they will lend me money to buy real estate because they believe in cash flow, right? You're seeing more of these products come to fruition. Yes, it's a little bit more challenging in a higher interest rate environment, but this is a great way where people say, hey, I want to buy property, but I've got the money, I've got good credit, but I don't make enough income. Well, use the income from the rental property itself. And again, are these rates fantastic? No, but it does allow you to secure real assets if you've been denied other places by using this ratio. Anybody done this before or questions on this? It's actually a pretty cool product. Whenever I talk to investors that don't they're like, no, this isn't possible. I'm like, yeah, it is. This is something that is pretty common and it typically blows their mind, which is cool. By the way, this applies to short-term rental properties like Airbnb and Vrbo or VRBO. You can look at a 12-month rental history and you're going to be maxed at 75 LTV. So again, like other investment properties, this is going to be probably 20 or 25% down minimum. But you know, you have somebody that wants to buy an Airbnb and it's already established as a short-term rental. Typically, a traditional lender, Fannie Mae, Freddie Mac's not going to touch that. You can do a DSCR loan and use the short-term vacation rental income from that, which is
That looks like a nice rental property.
yeah. If anybody is looking, if anybody needs short-term rental housing for the month of April, please let me know. It's very serene, very peaceful. Doesn't look like that was snow on the ground, but and then this is a cool product that you know, I talked to my friends in retail lending like G-Rate or Bell or some other places, because we do talk to each other and we are friends. This blows their mind, where Change Wholesale is a lender that has a 20% down primary residence product that is a common sense underwriting product. Matt, what's the name of this? Is it My Community Mortgage or something?
Something like that. I'd have to look up the actual name.
Yeah. So this is a product where with do not have to go through income documentation at all. The DTI is not calculated. The minimum FICO score is 640. So if you've got a 640 credit score and 20% down, you can buy, and that's it as a primary residence, right? There's nothing else that's required. Actually, this is just the one page of the bank statement. That is all that's required, which is a little bit crazy to me. But this is a product where folks have said, after what we saw in the housing crisis, like, again, if you've got 20% or more into a property, the idea is that housing values would need to fall a lot for you to walk away. And if you do walk away, it's pretty unlikely that the lender is going to be on the hook for a significant loss, considering the amount of equity you have into the property up front, right? You buy a $400,000 property, 20% down, that's a $320,000 loan. You know, pretty unlikely you're going to see the price of housing fall that 20% where the lender's going to be on the hook. So this is legitimately credit score, bank statement, that's it, primary residence. Rate's not great, but again, it is an option for purchasing.
It is a community called community loans. Yeah.
That's it, y'all. Any questions about any of this today? Creative solutions? Anybody want to bat some stuff around?
You got a chat question.
Would it be an option to buy down the rate if starting with a higher interest rate when using bank statements to qualify? Yes, you can buy down the rate. I've seen some of these with multiple points on them. That said, the question is always, Jennifer, how long are you to keep the loan? Because if it is, hey, I just need this for the next 12 or 18 months, and then I'm going to get a standard, rate term refi, probably not worth it to pay a bunch of points because you're only going to keep the loan for a short amount of time, right? If it's an investment property and you're like, hey, this cash flows and I want to get the payment as low as possible, have at it. And with non-QM loans, there's no limitation on the number of points that you can pay down. I saw a VA loan with 6 points on it the other day, which is criminal, and should not have been done, but it's not ours. It's one of these big box, I think it was USAA. Point being is that banks do not have limitations on the amount of points that they can charge. And similarly, non-QM has no limitation on the amount of points. So if somebody says, hey, I want to buy the rate down to whatever and pay 6% of the loan amount to do that, totally within their right. Colin,
you want to touch on one more thing actually for them?
Yeah.
You mentioned it for just the self-employment stuff. Say 2021, they made 125,000, then they made 75,000 in 2022. Is that a problem?
Yeah. So declining income can be a bit of an issue with all types of loans. When you talk about declining year over year, you will only average the 2 years if the income is increasing. So if you made 80,000 in 2021 and 120,000 in 2022, that's 200 grand. Divide that by 24 months. There's your figure. But if those numbers are inverted and the income is declining, there are a whole nother set of rules in terms of being able to use the income. But the most important thing to remember is that if income is declining, the lender is only going to use the most recent tax return. So, if you have 120 in 2021 and 80 in 2022, 80 is going to be a 1 year average. So they're not going to include that better year for you at all. That's a really good point. And then if your income has declined really sharply, you're into a bit of a sticky situation in terms of explaining that. So it's always best if your income is steadily increasing or staying stable, because that's going to help underwriting understand that, yeah, they're a darn good realtor. I understand, I mean, I also did a loan for a client that, they will have their income go up and down in odd and even years, right? I think this gentleman's wife works in politics. And so the election years, which are even number years, they make a bunch of money and then they don't make as much money. And then they make, common sense underwriting prevailed in that sense. So you're just going to want to have an explanation that corresponds with why the income might be declining. But that's a really good point, Matt. All right, I know you're all busy. Great to see activity picking up in the spring market, and I appreciate you taking 40 minutes to go over this stuff. Any questions, feel free to reach out to us. Thanks, everybody.